does value investing work? Yes, it does work, and you probably are not surprised by this answer, but there is a bit more to it, because as everything in life, of course, and financial matters, in that matter, no answer is simple, black and white, yes or no. We have to know context, we have to understand the idea behind it, and that's same about value investing as well, because, well, as humans, we try to think that everything we buy and purchase has some value, whether it's consumer goods, electronics, cars, or investments everywhere. We kind of think that we are making rational and valid decisions, and we are buying something that is very valuable, and we will have good utility out of those things which we buy. Now, in practice, you obviously understand that's complete nonsense, because like 90% of the time we are buying silly nonsense with money we doesn't have, or are not particularly smart to spend the things which are actually useless and hasn't served their original purposes. And I would say that's true about financial markets as well, because of course financial markets are prone to same irrational judgments as everything else, because we are humans. Our decision-making process are the same whether we are in shopping mall or in financial markets. So we are thinking that we are buying value, but actually we are not buying value. We are simply buying something which we think will rise in value very fast, and then try to justify facts that will support our claims. But that's a different topic. This is something like confirmation bias, and we won't cover judgmental biases in this video in that length. I want to tell you that we are kind of buying value and thinking that we are value investors all the time, but in fact is that we are not. But here's the thing, man who made financial analysis and stock investing as we know it, he was Benjamin Graham, actually made this approach popular. The idea was very simple. You simply buy companies which are worth far more than you could pay for them. And it was made famous by his first two books, not his first two books, but his most famous books, Security Analysis and Intelligent Investor. He made several observations there, but one of them was very simple and very blunt. For instance, you could buy a company whose assets are worth far more than the market capitalization of respective stock. Now, it was very simple to understand and simple to analyze. You simply look at the balance sheet and see how many net tangible assets there were, or how many assets in simple terms there were compared to liabilities. And if that value was more than stock price, you could simply buy them. And Warren Buffett re-quoted that as, I probably wouldn't make precise analogy as he told it, but idea was simple, that he made the example of cigars, that if you see cigars on the street, you could take them, light them again and make a couple of puffs and then drop them again, and you will have some fun for a short amount of time. And this was comparison to Benjamin Graham's idea to buy simply something which is worth far more than its price, simply by looking at their balance sheet. I think the idea came from Benjamin Graham itself, but Warren Buffett re-quoted that. Of course, this approach, it's practically impossible that for work today, because markets today are more efficient, and these kinds of opportunities could be found by anyone at the click of the mouse, so it wouldn't work there. But here's the thing, Graham's idea of something that you could buy simply below its actual worth worked in the one interesting way. Well, most of his students were money managers, starting from Warren Buffett, that you already know, and continuing to like 6 or 7 other investors. And Warren Buffett made this, I think it was Warren Buffett who either made it or at least known it to general public, that thing that they have several investors who were direct Graham students, which outperformed market by a significant margin for decades. And the article was named Super Investors of Benjamin Graham and David Dotswell or something similar. Then he made argument in this work against efficient market theory comparing to value investing. And he simply said that if you take that coin toss analogy, which is made by efficient market proponents who told you that if there are large amount of investors, some of them will be extremely successful due to the chance. And I agree to that. But Warren Buffett told you that how could that be simple chance if most of the Graham's students were successful money managers using very similar approach and were able to outbeat the markets for significant margin for decades? Well, it's highly like computer just went out. Yes, excuse me, I will continue my thought. What I was saying, it's extremely likely that a couple of investors who simply used the same approach were able to beat the markets for such a long term. That's not coincidence, that's result of one systematic approach which worked. And of course this approach also was used as well by Peter Lynch, where he, if you have read it, his works, many of you have been because it's very popular. He has similar approaches as Benjamin Graham and Warren Buffett, where he simply looks something unpopular and undervalued and waits for those companies valued to even out to market price, And yes, that has been worked to the levels that's significantly surpasses chances of mere probability, and results are very good and as well. What are these precise approaches? Well, this is different in question entirely, and I will continue this topic of these approaches in my next videos for sure, but now, due to the length of this video, I will just give you a couple of glances. Well, most realistic approach for today's markets is something which I would call find an angle, when you could start to look for companies which are in good financial health, with stable earnings growth or dividend history or economic mode. These are for only examples. And then you look at times when these companies became extremely undervalued due to some sort of outside effects that doesn't precisely impact its business model. Well, most extreme example here was, of course, COVID, where good companies were simply slammed by market prices because there were large unknowns here, but everything eventually turned out fine and many undervalued companies made huge fortunes. Well, another idea is simply to find companies with good growth prospects and good moats, economic moats, and to invest them via dollar cost averaging. Now, it's not necessarily foolproof way how to beat markets, because effectively here you are simply copying markets. But if you made portfolio of decent companies with decent returns on capital, you will do good. You will do much better if you try to overanalyze some sort of penny stocks or invest in hot companies because everyone else is buying them. Of course, there is more into that context, but the idea to buy some sort of popular companies like Coca-Cola, Apple and whatnot will make you safer than some wizardry as I described you before. That's second approach. Third approach is to simply find fast-growing companies which are not overvalued yet. Here, approach is a bit more contradictable because it's extremely difficult to find companies which are high-growing with good amounts of returns on capital, which is not that popular yet. I don't know whether Tesla is a good model here, because Tesla has really contradictory business model, and I wouldn't certainly call it value company in any of its lifetime. That's a different story. Maybe I will give you examples on these companies in next videos, but here this is just a third example. Of course, fourth example is to find companies which is worth less than their asset value. Example I told you in the previous videos, but here realistically you have to simply go for companies such as oil producing companies and similar companies in extremely bad times. It wouldn't happen each year or each month, but some of the time possibilities will be there. And then you could find a couple of companies which would be very interesting. Now, it wouldn't happen day after day. You could have to wait years for these approaches, but they will work. And in my next videos, I will show you more precise steps on specific details how this works. So stay tuned.